Bitcoin just broke critical support at $83,400. And here's what nobody's talking about. While retail investors are panicking and the fear and greed index is screaming in extreme fear, at a reading of just 28, BlackRock quietly absorbed $435 million. In a single day. Let me say that again. $435 million. And the largest institutional buying spree since the November post-election rally. So the question you need to ask yourself is this: slow down. Why are institutions buying aggressively while everyone else is selling in fear? In the next 6 minutes, I'm going to show you exactly what's happening beneath the surface of this Bitcoin market, the hidden data that Wall Street is watching, and the 3 critical price levels that will determine whether we're building the base for the next rally or heading towards $70,000. This is urgent. This matters to your portfolio. Let's dive in. All right, let's set the stage with where we are right now. As of February 1st, 2026, Bitcoin is trading at approximately $82,500. That's down 25% from the all-time high of $126,000 we hit back in October. Now, here's what makes this moment different from every other dip you've seen. On January 31st, Bitcoin broke below a level called the short-term holder cost basis. Now, I know that sounds technical, but stay with me because this is critical. This number, $83,400, represents the average break-even point for everyone who bought Bitcoin in the last 155 days. According to Glassnode's on-chain data, 19.5% of these recent buyers are now underwater. They're losing money. And historically, when this number hits, 55%, that's when we see true capitulation. That's when weak hands completely give up. But we're not there yet. Here's why this matters to you. At the exact same time, Bitcoin is breaking support and retail sentiment is collapsing. We're seeing something we've never seen before in crypto history. Institutional money, the BlackRocks, the Fidelities of the world, they're not running away. They're running toward this price action. In 2025, BlackRock's Bitcoin ETF pulled in $25.1 billion in net inflows, while Bitcoin itself was down 9.6% for the year. Think about that. Negative price performance, positive institutional demand, that's a fundamental shift in market structure, and it is creating a massive divergence between what the charts are showing and what smart money is actually doing. So let's break down the 5 critical developments that are shaping Bitcoin's next move. I'm pulling this directly from Glassnode, CryptoQuant, Bloomberg Intelligence, and Federal Reserve data. Development number 1, the technical battle zone. Bitcoin is stuck in a range between $81,000 and $95,000. But within that range, there are 3 levels you need to watch. $81,300. This is the true market mean, the level where patient buyers have been defending. If we hold above this, we're likely building a base for the next leg up. $80,000, pure psychological support. A break below here opens the door to the $70,000 zone. $93,000 to $95,000, massive resistance. There's a supply wall here from everyone who bought between October and December and is now desperate to break even. Development number 2, the ETF story. Everyone's missing. After brutal outflows in November and December, we're talking nearly $1 billion in single-day redemptions, something shifted in early January. Bitcoin ETFs posted $386 million in net inflows over just 4 trading days. And January 5th, $435 million in one day, with BlackRock taking 71% of that flow. Bloomberg's Eric Balchunas called this a Hodel clinic. What he means is this: institutions are treating Bitcoin ETFs as long-term strategic holdings, not trading vehicles. They're accumulating during weakness. That's a game changer. Development number 3, on-chain data shows seller exhaustion. Glassnode is realized profit metric, which tracks how much profit is actually being taken out of the market, dropped from over $1 billion per day in Q4 down to just 180. What does that mean in plain English? Sellers are exhausted. The people who wanted out have mostly gotten out, but, and this is important, there's still a massive amount of Bitcoin sitting between 93 and 120,000 that's either underwater or barely breaking even. That overhead supply is going to resist every rally attempt until we grind through it. Development number 4, the strategic Bitcoin reserve. On March 6, 2025, President Trump signed an executive order creating the U.S. Strategic Bitcoin Reserve. Right now, it holds about 200,000 Bitcoin, roughly $17 billion at current prices, from seized assets. And the key provision? That Bitcoin shall not be sold. States are following suit. Texas bought $5 million in BlackRock's ETF. New Hampshire authorized 5% of state funds into crypto ETFs. Arizona, Massachusetts, Ohio, South Dakota all have legislation in the works. This isn't retail FOMO. This is sovereign-level adoption creating structural demand. Development number 5, Federal Reserve policy uncertainty. The Fed held rates at 3.5 to 3.75% on January 28th. Jerome Powell's term ends May 15th. Kevin Warsh, Trump's nominee to replace him, is known for favoring lower interest rates. When his nomination was announced on January 31st, the dollar surged. Precious metals sold off, Bitcoin broke support. Markets are pricing in uncertainty until we see what Warsh actually does. Here's the critical insight. Bitcoin's 2026 path isn't about crypto anymore. It's about macro policy. It's about liquidity. It's about whether the Fed cuts rates aggressively or stays restrictive. Okay, so what does all this data actually mean for you? Let me break this down into 3 clear scenarios based on what we're seeing. Scenario 1, base formation, most likely. If Bitcoin holds above 81,300, that true market mean level, and ETF flows stay positive, we're building the foundation for the next rally. Smart money is accumulating in the 80 to 85,000 range. This is textbook institutional accumulation during retail fear. What to do? Dollar cost average if you're bullish long term. Don't try to catch the exact bottom. Let institutions do the heavy lifting while you build your position methodically. Scenario 2, deeper correction. If we lose $80,000 decisively, we're probably headed to 70 to 75,000. That's where long-term value buyers historically show up. It's not the end of the bull market, it's just a deeper reset. What to do? Have dry powder ready. True capitulation happens when short-term holders hit 55% losses. We're only at 19.5%. More pain could be coming. Scenario 3, Fed crisis pump. If the economy deteriorates and the Fed panics into aggressive rate cuts and quantitative easing, Bitcoin could rocket to 170,000 or higher. Non-yielding stores of value thrive when central banks flood the system with liquidity. What to do? Maintain core positions. Don't try to trade in and out. The big moves happen fast. The key takeaway is this: opportunity emerges from dislocations. Right now, sentiment is at extreme fear, while institutions are actively accumulating. That's a dislocation. And historically, that's when the best risk-reward setups appear. Not guarantees, not certainties, but probabilities that favor patient capital. Listen, if this analysis has helped you see what's really happening in this Bitcoin market beyond the noise and the panic, do me a favor. Hit that subscribe button right now. I'm bringing you this level of institutional-grade research, pulling data from Glassnode, CryptoQuant, Bloomberg Intelligence, Federal Reserve sources, and synthesizing it into clear, actionable insights every single week. No hype, no moonboy predictions, just evidence-based analysis so you can make informed decisions. Drop a comment below and let me know, are you accumulating in this range, or are you waiting for lower prices? I read every single comment, and your perspective helps shape future content. And if you found this valuable, share it with someone who needs to see what smart money is actually doing right now. All right, let's wrap this up. Quick but critical disclaimer before we close. Everything you just heard is for educational and informational purposes only. This is not financial advice. This is not an investment recommendation. This is not me telling you to buy or sell Bitcoin or any other asset. Cryptocurrency investing carries substantial risk, including the possibility of total loss of capital. Seriously, you could lose everything. Before making any investment decisions, you need to do your own independent research and consult with a qualified financial advisor who understands your personal situation, your risk tolerance, and your financial goals. Past performance does not guarantee future results. The data I shared is accurate as of February 1st, 2026, but markets change rapidly. Be smart. Be disciplined. Manage your risk. Here's what I'm watching closely over the next 7 days. That $81,300 true market mean. If we hold it, the base is forming. If we lose it, we're probably testing 70,000. And here's the thing nobody's talking about yet. The derivatives market is showing elevated funding rates at 0.51%. That means over-leveraged longs are getting squeezed. When funding gets this high, corrections usually follow within days. Next week, I'm dropping a deep dive video on Nostas, Bitcoin derivatives, positioning, and what liquidation cascades could mean for price action in February. You're going to want to see that analysis before the market makes its next major move. Until then, stay informed, stay disciplined. And remember, in Bitcoin markets, fear creates opportunity for those who know how to read the data. I'll see you in the next one.